Still love hearing the din of all the folks out there on the floor here at Consensus 2025 in Toronto. Steve McClurg, it's great to talk to you.
Thanks for having me.
The hardest way to make money is generating alpha consistently and raising money. Add to that entrepreneurial ventures, which doesn't make things easier. Like, why? Why do you bother? It's so easy. You're a skilled individual. You have transferable skills, yet you take the hard path.
That's right. I ask myself that all the time. I still don't know the answer. But
Guggenheim to Valkyrie to a successful exit there, and now to Canary Capital, a new venture. What do you hope to get done with Canary that was unfinished business from before?
Yeah, well, Canary was sort of an accident, actually. Mostly what I've done in my career and all I really want to do is run a hedge fund, and which is what we're doing.
But that's an expensive midlife crisis hobby, isn't it?
A little bit, but no, I enjoy it. I mean, what somebody asked me is like, how much do you read a day? I was like, oh, about 8 hours a day, you know, and that's just, I mean, that comes from my career as an analyst, as a trader. What a lot of people don't think, you know, people think that traders just sit in front of a screen and trade all day, you know, and if you're working an 8-hour day, you know, and you know this coming from TradFi as well.
Yep.
You probably spend 30 minutes trading, and if you're working an 8-hour day, which I never did, I always did more. You know, 7.5 of those hours is always reading and analyzing charts, and you know, staying on top of your Bloomberg and making sure that you know you're reading every single thing that comes through.
That's right.
And a pile of papers. I think something's coming off, but a pile of papers over the weekend at your favorite restaurant.
So, I guess this Canary lets you focus more on macro. And when we were talking earlier, I think you had a pretty significantly, let's say, defined view about what lies ahead in the U.S. economy that isn't necessarily the modal view right now that really pointed towards us being at the end of a comfort cycle going into dark times.
Yeah.
Could you just lay that out a little bit for people? Because I think it's a bold but well-supported call.
Yeah, I mean, there's certain things that I look at, and a lot of it is the, you know, it is the yield curve, because I was a you know, recovering bond trader, and when I saw the yield curve switch in December, in about mid-December, we went from an inverted curve to a normal, well, it's not really a normal shaped curve. I'd call it more of a flat curve. Mm-hmm. But the way that happened told me that the economy wasn't actually that great. You know, I did expect to start seeing inflation coming down, but inflation coming down because people couldn't afford to buy things anymore. And we're even seeing that in the data that's coming out in the first quarter of this year. Air travel is down. Cruise bookings is down. Restaurant bookings is down. Bar bookings is down. People are shifting their spending habits from, you know, I'm not even going to say higher end things, but even food that they're buying, they're buying less expensive food in the grocery store as opposed to more expensive food. Consumer debt is credit card debt is highest it's been in a long time, and really it's a tale of two different economies. The 10% of wealthiest people in the U.S. is really what is the only one that's exposed mostly to the stock market, that are continuing to see their wealth grow, where the other 90% is not. Mm-hmm. And they're continuing to struggle to pay mortgage, struggle to pay for food, and struggle to pay their credit card bills. And that isn't stopping, even though inflation's come down to 2%.
I want to get back to the yield curve, but hasn't that wealth disparity, or the, you know, that's been going on a while now? I mean, a call for a recession seems much more like there have to be triggers, right? If we're thinking about wealth polarizing, you know, we've been hearing about that for a while. So why is that starting to really take effect right now?
Well, the reason why it's really starting to take effect now is the last 4 years of high inflation.
Yep.
So when you see consumer spending decrease, consumer sentiment decrease, which all the numbers that we're getting in the last quarter is showing that. And again, the change of the yield curve is what really showed me that this is going to happen.
Yep.
But it is happening more drastically, and it already was. It's been happening for the last 4 years, but now we're really at a tipping point. And I do expect to see a continued decline in consumer spending across the board.
Back to the yield curve, it was a gut feeling that a lot of what the original trade brinksmanship was trying to do was get the 10-year yield lower,
Right.
to allow for cheaper refinancing of debt and to get some applause from the real estate community, maybe.
Yep.
And that just failed because the 10-year became a chess piece instead of a flight to quality.
That's right.
Is that an analysis that's I guess in line with your observations about the yield curve? And what are the effects of that? 10 years really never been a chess piece before.
Yeah. No, 10-year is a major chess piece. And just like you said, it is the index to which all mortgage rates are tied to. Mm-hmm. And unless people can begin to refinance their homes or even afford to buy new homes, we are going to see a big segment of the economy not buying houses, not upgrading, because if you're paying, like me, if you're paying sub 3% on your mortgage.
Yeah, me too.
I know, you lock that in. And now you're paying 6%, you're not necessarily going to upgrade because the massive amount of monthly payments that it's going to cost for you to upgrade. Or if you're a new home buyer, north of 6% is very expensive right now in this economy when you're trying to pay for other things. But even more importantly is even the 5-year. A lot of people don't look at the 5-year, but I look at the 5-year quite a bit because that's what high yield bonds are mostly tied to. And if you know anything about the high yield bond market, that is a market that usually only issues about 5-year debt. They never pay off that debt. They're always amending and extending. So they're taking out new debt to pay off the old, but never paying it off. So these represent a vast majority of small companies and mid-sized companies. And if they can't amend that debt, you're going to see a lot more bankruptcies like you just saw with Rite Aid.
Right. Now, this may not be a Canary hedge fund trade, but what effect is that? Does Bitcoin start to realize its destiny now as an alternative if the dollar starts to become a chess piece?
Yep. Well, one of the things we saw in the last 2 months, one of the things that I look at when I'm looking at investing in Bitcoin or other cryptocurrencies is I look at M2, global M2, and based on global M2, Bitcoin should be at about 125 today, 140 in the future because of projected M2 growth, global M2 growth. And a lot of that has to do more with the velocity of money. A lot of people have pointed out, well, new money isn't really being printed right now. Yeah, but the velocity of money is picking up globally. So in addition to easing from several central banks, not quite with the U.S. yet. So we're predicting higher global M2 growth, and so that is the basis of that trade. Mm-hmm. And about 2 months ago, there was a divergence where everything went down on tariffs, but then stocks stayed down and Bitcoin went up.
Yep.
And that really has to do with tariffs have a bigger effect on equities because they have to buy materials mostly from overseas or sell to consumers overseas or vice versa. So tariffs have a big drag on equities where they don't have the same drag on crypto. So
yes, but I'll challenge, not to challenge that.
Some drag,
but also, let's say, sensitivity to liquidity, right? And to risk aversion. And maybe this was the first time that Bitcoin wasn't sold first, right? As the most hobbyist or least necessary asset, the most sensitive to liquidity, right? So you're talking about fundamental differences why crypto is less tariff sensitive, but that's fundamental. People always don't always think fundamental.
Yeah, fundamental is only one side.
Correct.
Yeah, absolutely.
So before we get back to the next digital asset parts of your company strategy, so what's the right macro way? Let's say pretend that you can't touch digital assets yet to prepare. Is this a dry powder situation, or is it long convexity, or is it just, what do you do?
Yeah, so there's a couple of interesting trades on the bond side of things, and our fund does both bonds and crypto. We hedge the crypto positions with bonds. A lot earlier in the year, we really focused on shorter duration assets.
Just to take duration out of the portfolio.
That's exactly right. We
Yep.
don't want to have any interest rate sensitivity because we didn't know what was going to happen.
Right.
You know, we had expectations, but if you can get, I don't know, I can get 5% on less than one duration bonds, I'm going to take that.
Right.
Right. Now, one of the good moves, I think, is adding duration right now, but on the very long end of the curve, 30-year. Right. So I either want under 1 year or 30-year. If
the 5
if
and the 10 are
focus-
just too hot right now. Right?
Oh yeah, it's way too hot. It's
Right.
all over the place.
Right,
You know,
right,
if you want
right.
volatility, buy Bitcoin.
Yeah,
not the 10-year.
Yeah. That's something. Wow, you wouldn't have heard that at any previous consensus.
Exactly.
Like, okay, that's interesting.
Yeah, but today the way we're positioned is, I mean, almost 95%
Right.
digital assets and about 5% in short duration.
So in the recovery, Bitcoin led. I said in a piece that actually our conversation inspired that Bitcoin was like a mooring for the tariff tantrum, and then shape-shifted into this all-time high seeker almost overnight, right on cue.
Yep.
But it took Bitcoin's recovery to get the rest of the market woken up, and I think that's the big problem. If you really expect layer ones to start leading their own kind of rallies, are we going to be stuck in this situation where you really need a Bitcoin rally and then you have a rubber band and everything else attached?
Well, the thing is that usually happens.
Yep.
And I do think it'll happen to a certain extent this cycle, but not as much as it has in previous cycles. And the reason why is breadth of market. Usually it takes retail coming in a heavier way for alts to start to begin to rally. But if, again, 90% of the market, of the retail market can't afford groceries, they're not buying, random token that's, 100th market cap.
Not buying Trump token.
Exactly.
I know you can't talk about filings, but the most have observed that you're placing a couple of bets that retail investors will want to, I guess, own and potentially trade a wider variety out of convenience because they can do it out of their brokerage accounts. Where do you see, I mean, we saw what happened in Europe with a lot of single name digital asset ETP issuance. There's some volume, not a lot of AUM. They're clearly not storage or retirement investment vehicles. They're trading vehicles. How do you think things will unfold in the United States, which is much more brokerage kind of culture to start with?
Yeah, it's so much more of a retail trading environment here in the United States. I mean, even the Bitcoin ETPs in Europe don't have a whole lot of volume. It's kind of store of value, and they charge very high rates. Where here, the fees are lower, there's a lot more trading activity. So I believe that you can get out to probably the top 30 in market cap tokens, and you'll have people that will want to trade them as long as it's something that is traded in the U.S. Mm-hmm. But you also have to keep in mind that there's a lot of other jurisdictions that trade U.S. ETFs as well, such as UAE. Because of the just because of the tighter spreads here, South Korea, so it's a lot more of a global market here that will induce trading and activity. So we think that we're making a good bet.
I started the day at another panel saying that it felt like 1999, where online brokerages made stock trading a lot easier, and that kind of democratized access to technology that some people thought they understood, or people went down the education curve pretty deep, to some people's peril, but ultimately to success of the tech asset subclass. Does it feel a little bit like that to you here as crypto becomes democratized to trade?
It feels a lot like that. I mean, you're going to have your stamps.com, your pets.com.
Right.
If you remember those from those days.
Sure do.
And everybody's like, oh, people are going to buy stamps online,
Right.
And so there will be some tokens that do that, but I think at the end of the day, the ones that are building real enterprise solutions, doing tokenization. I mean, Bitcoin's in a category all of its own, along with Litecoin, which is money, but everything else is going to fall into, okay, what is its usefulness, and does it have a future?
It's. Since the last consensus, it feels like a lot's changed since Austin of last year. We were all just still in a dream state after the Bitcoin ETFs were released, even before options and things like that. What's the most exciting thing you can imagine taking place between now and Consensus 2026 down in Miami?
Yeah,
Besides a shorter flight for you.
Exactly. Well, Austin, I mean, that was still we were still recovering from FTX,
Right.
And the bear market at that point. So I guess the difference is in Austin, I was riding around scooters because I couldn't afford a cab, and we can afford cabs now.
Right. That's you personally, and I hope you can afford even better than cabs as we go forward.
Absolutely, exactly.
Cool.
Yeah, no, it's definitely the market has definitely picked up a lot more, so it's made things better.
Fantastic. Stephen, thank you so much.
Thank
It's
you.
great talking to you. Thanks, everyone.